The week before was dominated by the Fed and what it would do to all markets. But this week has been dominated by Asian central banks. The BOJ has sounded less hawkish than was expected. And the Chinese central bank, the PBoC, has surprisingly cut more than expected. So there is a lot to discuss on rates, commodities, currencies, and what it can do to, of course, the Indian economy and Indian stocks. Joining me are two experts from JPMorgan. We have Jahangir Aziz, who heads Emerging Market Economics, and Luis Oganes, who is the head of Global Macros, Commodities, Currencies and Rates at JPMorgan. Luis, Jahangir, thank you very much for joining me.
Thank you.
Well, let me start with the big announcement from China. Yep. Was it more than expected, this 20 basis rate cut and promises of more cuts? What does it do to the Chinese economy?
So there are two separate questions. So the first question is that was it expected? It was more or less expected, right? But you have to look at the two of them separately. The 50 basis points of RRR cut, that was meant to create enough liquidity for the Chinese government to continue to issue bonds, because that was a basis in which we had called for a 50 basis points of rate cut. The 0.2% repo cut, that was tad higher than what we had. We had a 10 basis points of cut. But again, the amount and the timing of that was always quite uncertain. Clearly, as you pointed out in introduction, the Fed cut of 50 basis points is having an impact on emerging market in Asia. Asia was the place where you did not have enough amount of cushion with the Fed, and that was where the concern was that these countries or these current central banks could not cut without triggering concerns about and financial stability. I think the rate cut by the Fed has opened that space, and I think you will see other central banks follow. BI was the day before, yes. And BSP is probably going to be adding more rate cuts. So I think that the overall idea that the Fed, intransigency over its rate cutting cycle and making us wait for quite some time was holding back
the central banks in
banks in Asia, particularly, not in Latin America or other places, is playing out to be true.
Okay, before you analyze the impact on the Chinese economy, sure, which we are all terribly interested, just to complete the argument, does this make it more incumbent on the Reserve Bank to act, at least from the currency angle? Because if there are so many cuts and the Chinese central bank also cuts, rupee appreciation will be uncomfortable.
So I wouldn't bring FX directly into it, okay, because obviously, RBI has a, very ambivalent attitude towards what it does to the rupee, insisting that it only smoothens out volatility. But clearly, they have a view about where the rupee goes. But I would say that it's much more domestic driven, the need for RBI to cut. So if you have an economy, and let's not go into what recorded growth is or not growth is, let's look at the proof of the pudding. The proof of the pudding is core inflation. And core inflation today is at its lowest level since the inception of the index in 2012. And it has been falling over the last 9-10 months. I've lost count of that. In any country where core inflation has fallen to this low level, and it has been actually falling on a sustained basis, it always smells of serious excess capacity in the economy, and not only excess capacity, but widening excess capacity. You can have, core inflation falling 1 month and then go back at other, and then you can say, well, it's something else that was working. And but 9-10 straight months to its lowest level in 2012. So I think that it is incumbent on the RBI, just like the Fed did, which is that we need to recalibrate the restrictive terms. Nobody's asking them to be
calling for a December cut or an October cut itself.
So my India team does not have an October cut. They say that in October they will change their language, okay, and then there'll be December cut. I'm probably on the side that why change the language only? If this was a 25 basis points of cut by the Fed, then I would say, yeah, change the language and then go for a December cut. It's a 50 basis points of rate cut.
Okay. Well, there has been a 50 paise appreciation of the rupee. It was almost 84 and it's gone all the way to 83.50. But let's see. Let me come to the reason why perhaps core inflation is down, at least a small reason, is this huge Chinese disinflation. In specific areas like steel, EVs, solars, it's very clear. The Tata Steel managing director was on our channel on the record saying that the Chinese are selling steel HR coils at $50 lower than their own cost. So, Luis, to come to that, do you think the Chinese disinflation recedes somewhat if the rate cut recharges that economy?
I don't think that is going to recede anytime soon, because the problem is that China has a problem of excess supply right now because there is not sufficient domestic demand. There is still a problem in the real estate sector, which demands a lot of steel, to your point, or other commodities. And the solutions to that are not, anywhere to be seen. And we know from experience of any country that has had, boom-bust cycle in the real estate market, it takes time for this cleanup to happen. So what China is doing is obviously, keeps manufacturing and keeps flooding the global economy, global markets with its, cheaper production. Yeah, that has been generating a lot of reactions, right? U.S., Canada, EU, you name it, imposing restrictions, some tariffs or protesting, this attitude. But China is not, they see it to their benefit. Yeah.
Yeah,
so
exactly.
I think that this is disinflationary impulse from China, in my mind, is going to continue.
Is not going away anytime soon.
No.
Okay. Just a word on the Chinese currency as well. It has appreciated from around 7.3 a couple of months ago to 7.03 now. Do you expect all currencies have, like the rupee has. What's your sense about the yuan itself? Will it depreciate more because of the inherent weakness?
I think that the path in our mind is more for depreciation, but there as well, to the extent that it is a currency that is heavily intervened, right? And
yes.
And the reality is that I think that at this stage, probably the Chinese authorities don't want to add insult to injury, promoting more currency weakness than what is strictly necessary needed, but. Growth weakness, interest rate cuts that you're discussing here, all that points to less support for the currency. So I think that the path should be for weakening. And we're not even talking about what may come next in the U.S. if there's tariffs, etc. Right?
Oh yes. We'll come to that because that's such a binary event, the U.S. elections. But if there is a dollar depreciation and yuan depreciation as well. India has the highest current account deficit with these two countries. I don't see the Indian Central Bank not reacting to it, and that buttresses your point. But what about the Chinese economy itself, Jahangir? You said that the 50 basis, CRR cut or whatever, triple R cut is to give space for fiscal stimulus. With a bit of more fiscal stimulus and this monetary stimulus, are you any more confident?
Look, so we have been continuously disappointed on the lack of change in the direction of policy. As Luis was saying, it isn't so much you need more quantum of fiscal stimulus. You need the fiscal stimulus to be in the right place. So China is facing a problem where domestic consumption has been continuously disappointing. On the other hand, if you look at fiscal policy has not provided any support to domestic consumption. Fiscal policy continues to push in towards more production. So if you have more fiscal stimulus that goes into fueling more production, then exactly what Luis said is going to happen, which is that the excess capacity increases, inventories build up, and the Chinese will have to find another market outside of China to sell their goods. Deflation is a serious concern in China, not just deflation in export prices, but also deflation internally. So we have been looking for a shift in the policy direction, not
towards consumption,
whether it takes the form of income transfers, whether it takes the form of more support to low-income housing, to public housing. That's the change that we have been looking for. And unfortunately, we've been waiting for a long time for that change, and that change hasn't happened.
Okay. Fine. Let me shift to the other major Asian country which has suddenly loomed in terms of importance in currency markets in particular. What's the expectation from Japan? More hikes?
Yes. So we have to understand that what has happened in Japan is not a fluke. It is not all of a sudden that inflation is coming back. Japan did take significant amount of structural reforms in the past 2 years, and the result of all of that is that Japan finally is seeing inflation going up, wages going up, and that is being done with concerted government effort. We have a rate hike in December, but we have 2 more rate hikes in 2025. Market only has 1 rate hike right now priced in. So our view, and Luis, correct me if I'm wrong, is that if you get these 3 rate hikes rather than just only 1 rate hike, which is what the market is pricing, the yen appreciation that you've seen more likely has more legs to go on. And the argument, and just to connect to the previous point that you were trying to make about why CNY appreciated, the first leg of that appreciation, not the second leg, but the first leg of the appreciation was the unwinding of the yen carry trade.
Yes.
So that did have an impact. So in our mind, we are significantly above the market consensus in terms of where BOJ will go. And if that's the path, then my guess is that currency is probably headed towards more appreciation rather than depreciation.
Okay. But before I take a break, the most important question which our viewers will want to know, where is the yen headed, and is there a chance of a repeat of the yen carry trade unwind which hit us in early August, or these things don't repeat really because the world is prepared?
The projection that we have is that the yen is going to be, potentially crossing, piercing again the 140 level, going to the high 130s. But this assumes a U.S. going into a soft landing and nothing dramatic happening around the U.S. elections. If we get a U.S. recession scenario, it is possible that we actually get more rate cuts by the Fed. It is possible we'll get to the low 130s or even the high 120s. This is clearly not in the market. As Jahangir said, our team expects more hikes than what the market is discounting right now. So if you speak to JPMorgan traders, dollar yen is a currency, so the yen is a currency that they seem to favor, just because it is still not consensus. People are not convinced that these inflation dynamics are here to stay, that the policy path for the BOJ is for more hikes. This is still, not everyone is believing it.
Well, hold on to that thought. I have to take a break on that note. We are going to continue to speak with Jahangir and Luis. You will get to hear the whole show after market hours. For the moment, after break, Chartbusters.